Hi everyone, my name is Trang and I'm delighted to be back to host the final two episodes of our Refinitiv Perspectives Live 24-hour special. Our penultimate episode will zoom in on the outlook for oil for 2021, and I'm really excited to introduce two subject matter experts to join me to chat about these issues: Shirin Lakhani, Senior Oil Analyst at Rapid Energy, and Jim Mitchell, Head of America's Oil Analyst at Refinitiv. Welcome both.
Thank you for having us.
So I guess to kick us off, I wanted to turn to you, Shirin, to talk about a very surprising move by Saudi Arabia to cut production by 1 million barrels a day, if I'm not mistaken. How do you see the immediate impacts, and how will oil prices react, in your opinion?
Yeah, absolutely. And again, thank you for inviting me and Rapidan to be a part of this really exciting format. And what an exciting year it's already been. I think we're only 20 days in, or I guess 21 where you are. But indeed, like you said, there have already been several surprises, including Saudi's voluntary 1 million barrel a day cut in the last ministerial meeting. So up until that point, we were of the opinion that prices were actually jumping ahead of fundamentals. So we previously had our Brent price forecast averaging about $45 in 2021. It's clearly not 45 anymore. But I think this cut now justifies a $50 handle for oil prices this year. So we now see Brent averaging closer to $54 this year, still a touch below the forward curve. So we do think the market's just a tiny bit frothy at the moment. But I think the result of that cut are two things, two major buckets that come to mind because of that 1 million barrel a day cut. And the first is U.S. shale. Right, so $50 in many ways is a magic number for the U.S. In terms of break-evens, yes, but I think more importantly, psychologically, we've been saying for a while that the U.S. would need a sustained, keyword sustained, $50 oil price to meaningfully recover post-COVID, such that new production could outpace natural declines. So where we previously had lower 48 U.S. shale flatlining in 2021, we now see a 600,000 barrel a day exit rate increase year on year, still about 1 million barrels a day below the pre-COVID peak. So shale especially benefits in 2021 because decline curves are flatter right now than they would be if the Saudis gifted the U.S. this cut next year. So that's one big thing to keep in mind. This move, directed by the Crown Prince himself, was a gift to U.S. shale. So that's the first big bucket for this year. And I think the second important thing to keep in mind, and the reason why we still think the market's just a little frothy right now, is this list of really significant bearish risks at play in 2021 specifically. So there are three that come to mind immediately. And the first, and I think the biggest, is Iran. And I think this is one of the more underappreciated bearish risks, the fact that Iran is coming back this year. So our newly inaugurated President Biden has made it very clear that renegotiating the Iran nuclear deal and bringing the Iran and U.S. back to the same table is one of his priorities. So we do expect that to result in some bleeding of barrels from Iran as early as March, to the tune of about 500,000 barrels a day. And then once the nuclear deal is back in play, there will be a 1.8 million barrels a day back on the market that's currently being held offline. That's a lot of barrels to bring back, and rather quickly too. And I don't think the market's really appreciating the pace at which that can return. The second bearish risk is OPEC plus cohesion. So remember that Saudi's voluntary cut is only through March. So come the March ministerial, where they'll discuss April and potentially May production, Iran will already be bleeding barrels, right? Libya will continue to show strength on the supply side. U.S. shale will start rebounding. And then you start to need to have this serious conversation among OPEC plus members about market share. So yes, the market's tight this year. but any sign pointing towards lack of cohesion or compliance fatigue, or even a desire to kind of accelerate tapering among this group could easily tilt balances back into a surplus and kind of start building inventories again. So I think that's something we have to watch closely, especially in the second quarter of this year. And then the last really big thing to keep in mind in terms of bearish risks that are still in play in 2021 is demand, right? So COVID cases are rising, lockdowns are becoming more strict, especially in Europe and in Asia, which is a key demand center. So any hiccups along the way with the vaccine distribution or with these new strains of COVID making their rounds, and we could see a setback to recovery in the second half of 21. So just to quickly recap and close the loop on this thought, Saudi's cut, great for US shale this year, but there are still a number of very real bearish risks that could still play out.
Thank you, and thanks for the recap. I was kind of trying to get my head around of all these different things to watch out for, and like you said, it's been 21 days in January. But you touched on inauguration, and it's been a pretty action-packed day one for the new U.S. president. And I think there were talks around the Paris Agreement and the blockage of that really controversial pipeline project. So I wanted to actually get both of your views on what is the immediate energy focus for the new Biden administration. And perhaps, Shirin, we could start with you.
Sure, absolutely. So like I said, Iran is a big one. I won't reiterate that, but like you mentioned, Keystone XL, it's off. It's over. It's over. So that was a day one executive order. It's been signed, and really no surprise there, right? Because this is a really great way for Biden to to make his climate policy known, and demonstrate his commitment to these climate policies. And frankly, it's easy to do. It literally takes a stroke of a pen. But what does this mean in terms of, well, there's a couple of things. First, if you think in terms of crude pipeline egress out of Canada, long story short, as long as the Line 3 replacement and the Trans Mountain Twin go through, Canada won't really even need Keystone XL in the medium term. But I did just read this article before getting on the call about Williams' CEO saying that this pullback on Keystone XL could make it really hard to justify greenfield interstate pipeline projects in the future. I do think that that's less of an issue for liquids pipelines. And I'll leave it to Jim to comment on natural gas and LNG. It's definitely his expertise more than mine. But at least in the US with liquids pipelines, we're pretty overbuilt pipeline capacity kind of everywhere. So unless WTI hits $70 anytime soon, which we don't quite see on the horizon yet, a lot of that pipeline space is going to remain underutilized. So that's the big deal on Keystone XL and other impacts to permits and potential delays. And we can talk about fracking ban, we can talk about ESG, but I think one thing that a lot of folks aren't paying any attention to is taxes, right? Everyone's favorite subject. So there's a whole slew of industry-friendly tax provisions that could be on the chopping block later this year after a stimulus bill and infrastructure bill are passed. So these include the intangible drilling cost deduction, percentage depletion accounting method, real sexy stuff here. LIFO, the Safe Drinking Water Act, or what's commonly known in the industry as the Halliburton loophole, and a few others. But bottom line, in terms of impact to fundamentals, if these policies are rescinded, we could see break-evens increase by about 10%. But keep in mind, as long as marginal costs are below oil prices, that shouldn't make a material impact to production decisions. And then we could see a hit to marginal wells. So wells that produce less than 15,000 barrels a day, and they make up about 7% of US production. So I'll stop there and I'll let Jim kind of hop in and share his perspective.
Oh, thank you. Yeah, I absolutely agree. for the most part. On the Iran nuclear deal, I think it's going to be longer than some may anticipate. I think the Biden administration is going to learn from some of the mistakes of the Obama administration and in creating that deal. And I hope they also learn from some of the mistakes of the Trump administration and administering sanctions and why those sanctions didn't work. I think in there lies a longer process. If Iranian barrels do come back, that's typically going to be a heavy grade, which is going to pretty much back up some of that. It's not going to touch much of the lighter grades. So a different perspective on who the impact is going to be, which is going to be a longer conversation. Keystone XL, KXL, I agree that it's, to be honest, not that big of a deal. Trans Mountain is a big deal. Canada's already finding customers all over China, as far south into the areas around Cambodia and all the way up to Beijing. Every single one of these refineries are not built to take that heavy grade. So it's got to be mixed in with a lighter grade like ESPO coming from Russia, which they get, and they get a lot of. And they're also taking ANS, Alaska North Slope, of which they like. But the Canadian, it's the grade Cold Lake. It's the cheapest grade that they're going to get anywhere in the world. So they're going to maximize the amount that they're going to take from there. To do that, the Westridge dock needs to get finished, and the pipeline expansion needs to get finished. Now, as it goes south, we're somewhere around 100,000 barrels a day via rail. I suspect that we'll ramp up, given that the economics are what they are, to somewhere close to where we were at the beginning of 2020, which is 411,000 barrels a day. So there's a substantial ability to increase, and these barrels will come to Chicago, and they'll come down to the Houston refining area down here. Why that's important is because the Canadian heavy will displace the Mexican heavy, which makes then Biden's stroke of the pen, as Shirin mentioned, an interesting and kind of oddly position for Mexico to be in, because they like the canceling KXL, because that means that Mexican Maya has a better shot of getting into Houston. And Houston does import a lot of Mexican Maya, as does Corpus, by the way. But the Mexican government and President Obrador is essentially a progressive liberal like President Biden. But a third of the Mexican government revenue comes from the oil industry. Obviously, he knows that because a lot of it comes from his home state in Tabasco. So that poses a bit of a tension. And this tension we're going to see play out. I just saw, as Shirin mentioned, I was reading an article right before this, and it talked about that Justin Trudeau, the Prime Minister of Canada, and President Biden's staff have already set up a call to discuss KXL. And there's another problem in Michigan that they have to deal with that we haven't brought up. That's not as big a deal as KXL, but it's going to be a big deal to a Canadian company and people in northern Michigan who don't want to freeze to death. Fracking ban on federal lands. This is going to be another one that's contentious to the Biden administration, because a lot of that onshore is happening in New Mexico. New Mexico is a Democratic state, and somewhere in the neighborhood of 30% of the state's revenue comes from oil and gas. So banning fracking completely, that's going to be a difficult thing. Banning new fracking can be a little easier to do.
Wow, so many insights. I feel like my head is spinning a bit, and obviously I'm not an expert in this field. So really thank you for sharing all of this. And I think, Shirin, you touched on recovery in a post-COVID world. So I wanted to kind of delve into that a bit further and really ask about what your thoughts are on recovery, especially with the vaccine being rolled out, and also US shale production.
Yeah, absolutely. So the IEA has come out and basically said that they don't see any major structural changes to the market because of COVID specifically over the long term. That being said, we don't see a return to the 100 million barrel a day demand marker from 2019 this year. But we start to get close. So we have demand rebounding to 98.5 million barrels in 4Q of this year. So averaging the year at 96.5 million barrels a day, because that recovery, that impact to fundamentals from recovering demand from that vaccine rollout is really starting to show up in the balances in the second half of the year. And then again, as we discussed with US shale earlier, the US benefits from a higher price strip this year and flatter decline curves. But beyond 2021, even with continuing demand recovery, we don't see US shale growing by more than 5% year on year. And that's exit to exit, not even average. So a big driver, I think, though, of demand growth post-COVID will be petchems, and just the number of processing facilities and crackers popping up all around the globe right now, including in Asia. So while crude production in the US and other non-OPEC countries will be flat to declining in 2022 and beyond, NGL production should continue to grow and could provide a bit of a bright spot in the market.
Thank you. And Jim, I think you've touched briefly on refining capacity, especially in China, which I think is set to eventually overtake the US. How do you think this will impact US demand?
Well, in a couple of years, it looks like China refining capacity will overtake the US, and that's kind of a dubious honor. It will have some pretty significant impacts, though. If China increases and the US decreases, as it likely will, as there's a lot of smaller, by smaller I mean less than 50,000 barrels a day refinery in the US, as those get idled, it's going to create a balance of trade issue. It's going to put California in a possible precarious situation if some of those refineries in California are the ones getting idled, and we've seen in 2020 that some of them are idled, because it's going to mean that China is going to be a bigger exporter, which means the balance of power in the refined products market is going to change a little bit. It's still pretty much China and South Korea being the big exporters into the Pacific. But as it relates to South America, Ecuador, Chile, Peru, the U.S. still has a substantial foothold in exporting barrels to those countries. If China does start to increase their ability to refine products, they're very likely going to, from an economic standpoint, going to be able to take those export destinations for U.S. exports away, which then creates kind of this Pacific balance of power thing that President Biden is going to have to deal with.
Thank you. And I also wanted to touch on peak demand and whether that's still a concern, especially as electric vehicles really take the spotlight and so many technological advancements being announced around battery storage and everything around those lines. Are we close to peak demand, Shirin?
I would say not as close as most people think. And I think along with our Iran call, it's probably one of our more out of consensus views at the moment. Long story short, right? Boom follows bust. Are we out of the bust? Not quite. We're all still a little hungover from COVID, and we will be for a little while. But there is a boom coming, and we think that will be in the second half of this decade, so closer to the latter end of this decade. So global oil demand will grow by 2 to 3 times faster than the current peak demand consensus expectations this decade. And so consensus, let me just elaborate on that. Consensus expects that these energy transition policies will crush gasoline demand. But our analysis and our tracking indicates that those policies are quite weak, and as a consequence could lead to very much the opposite of peak demand, up to triple-digit crude prices later this decade, along with the massive tailwind associated with that to oil equities, right? Again, this is a longer-term, latter half of the decade kind of view, not a midterm view. So I think a couple things that the agencies seem to kind of overlook are consumer preferences, budgetary, political constraints, competing priorities, right? So prioritizing economic policies to revive economic growth post-COVID will likely take the front and center, and that will, I think, impede the pace of the transition. Not that it won't happen, just the pace of it will be a little slower than consensus expects right now. And I think also, China has been quietly climbing down on its support for electric vehicles, and I think that's been a little overlooked as well. And then, like I said, the fuel economy regulations in the US are a bit weaker than advertised. And then there's also these revolts all across the world, from Paris to Chile, over abrupt tax increases or fossil fuel subsidy withdrawals. So all of these factors, I think, point to an underappreciated demand-driven upside later this decade. So in terms of peak demand, I think I would, in this case, sell the rumor and buy the fact.
Thank you. And I would love to actually hear your thoughts on electric vehicles in China, but maybe that's a topic for another episode. So I think linked to that answer that you had, I wanted to touch on the latest report by the International Energy Agency that was really highlighting the resilience of renewables as one of the key findings, especially amidst COVID. So renewables becoming ever more competitive, and I guess countries announcing all sorts of green stimulus packages. How do you see the outlook for oil being shaped by all these developments? I think I want to ask both of you, maybe Shirin and then Jim.
Sure, absolutely, yeah, and good transition. I think the impact in 2021 will be a bit muted. So if anything, we could start seeing these ESG-related policies to start having an impact in 2022 and beyond. But keep in mind, these ESG programs are largely shareholder-driven. So companies with plans already in place might feel less of a bite from at least policies in the US through the new administration. I think it's also important to understand the mechanism through which the administration could implement these kinds of policies. So it would primarily be through a series of financial regulations, right, through the SEC, through the Fed, that would block access to low-cost capital for fossil fuel companies, right, based on climate considerations. So a couple of examples, right, they could require publicly traded companies to disclose climate risks. They could require that they include climate-related shocks in their financial stress tests, et cetera. But I think the impact of these types of regulations won't really be felt until next year and beyond. And I think they would likely hit smaller publicly traded companies that aren't already trying to get a head start on implementing climate-related policies disproportionately.
Yeah, and if I could add, ESG has been around the energy business. I started at Shell in 2001, and they were doing it then. And I have a bunch of examples that we're running out of time for. One example that I want to bring up, though, is from Imperial Oil in Canada. Imperial Oil has been doing this for 100 years. One thing that's really remarkable about this particular company, even before they start a project, even before they put a shovel in the ground, they have a crew of biologists go in there and take seed samples from native plants. They scrape up all of the topsoil. And what's really amazing to me is they scoop up some of the subsoil root debris. So basically, Imperial Oil knows all the nutrients in the soil of the area of where they're going to build their plant before they even build their plant. So when it comes to reclamation, they have all that stuff. And when you see some of the things that Imperial Oil has done, it's incredible. They have a team, not a person, a team that studies how to encourage animals to remain on reclaimed land. Who does that? I don't see any of the renewable companies. Certainly Tesla doesn't do that.
Interesting take on it. Actually, that's probably not the one that you see in the media headlines most of the time. So thanks for sharing that, Jim. And I think there will be a related question that I will wrap up with, which is really around who are the key winners in the energy transition. But before that, I just also wanted to get your thoughts, Shirin, on I guess big oil really kind of investing more in clean energy and that transition to becoming, I guess, greener, and then the pressure really, I guess, increasing on these companies. How do you see that changing or progressing in 2021?
Yeah, absolutely. And Jim, I think he brings up an excellent point. I myself have had the pleasure of working within several sustainability teams across the extractive space, so in gold mining and in oil and gas. And I think a lot of people don't realize how much these companies, granted, especially the bigger ones, they do care about being socially and environmentally responsible citizens. Are they perfect? Absolutely not. They'll be the first to say it. But it's not difficult to get these companies to understand and appreciate the immediate impact to the bottom line from having more efficient, less pollutive operations in place, and having social license to operate. That being said, I do think that larger and more vertically integrated firms will have an easier time adjusting to these various initiatives. Last month's Dallas Fed Energy Survey actually had a whole section on ESG, where the survey participants indicated that I think it was about 83% of larger firms already have ESG initiatives in place, but 54% of smaller firms don't have any in place at all. So I think the impact as big oil comes into clean energy and starts to more transparently embrace these policies, I think there's likely to be a disproportionate adverse impact on smaller producers, especially.
And I guess the final question is to you, Jim, on actually the same question, and also where you see the winners and the losers in this energy transition.
Yeah, so if one views energy transition like an oil person like I do as handcuffing the U.S. industry more than anybody else, then who in the oil industry are the big winners? Russia, China, Saudi Arabia, easily. Brazil is going to be in place to double their production to probably somewhere around 6 to 7 million barrels a day, and they will be able to take that piece that the U.S. was exporting. That's going to be up for grabs. Guyana is another one. They're not exporting a whole lot right now. As they expand, they can expand to 1 to 2 million barrels a day. Also, don't sleep on a country like Namibia. Namibia's geology looks a whole lot like West Texas, and it's from the same time, the Permian Age. Offshore Namibia looks a lot like Guyana. So this relatively poor country in the southern part of the African continent has a massive amount of oil and waiting to be extracted. Now, in the U.S., in general, who are the winners? As Shirin mentioned, bigger producers that are well-financed, because capital is going to be an issue. If anybody's drilling in non-prime spots, those projects are going to get looked at. And because typically those are going to have higher production costs anyway. And that may be where these bigger companies start to find some of their cash flow to finance production. Pipelines, probably existing pipelines, great business model. They're probably going to continue to spit out big dividends, a little bit of volatility maybe. We talked about petchem, especially around polyethylene. This piece of the business is going to expand worldwide, everywhere, and in the U.S. certainly, as we have some of the cheapest ethane in the world. Who's going to struggle? Anybody with high debt, regardless of what piece of the industry you're in, if you have high debt, it's going to be a rough road. Refiners, going to be a tough road for them as well. New projects, midstream, more because it's overbuilt and they traditionally carry a lot of debt. And also lower income Americans, like we've seen in California with they increased their electricity rate 8.1% 20 days ago. And as I mentioned on my podcast, Angelinos, the residents of Los Angeles, pay 3 times the rate for power that I pay here in Houston.
Thank you so much. I know I could probably pull up on each of and all of these questions and answers, but I know that time is running out. But again, thank you for all the really valuable insights around oil price predictions, oil demand, refining capacity, access to capital being a big challenge, the impact of the new US energy policy, and I guess the energy transition, which is really top of mind for so many of us. So thank you, Shirin and Jim, for joining us today. And if everyone wants to find out more about oil and oil outlook for 2021, there is a QR code on screen and a link in the chat to access our latest oil research. And I'll be back for a final episode, really talking about investment trends and what the future holds for 2021 to wrap up our 24-hour marathon. So do come back in half an hour at 11 a.m. Singapore time, and I look forward to seeing you there. Bye.